Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Liquidity Ratios Explained, a practical guide to measuring financial health. Managing cash flow is critical for any business, and that's where liquidity ratios come in. These financial tools give a clear picture of how well a company can cover its short-term debts. From investors to business owners, understanding these ratios helps make smarter decisions. In this video, we'll break down the essentials so you can assess financial health with confidence. What are liquidity ratios? Liquidity ratios are essential tools for evaluating a company's ability to meet its financial obligations. They reveal how well a business can use its current assets to pay off short-term debts, acting like a financial checkup for the health of the company. For businesses, investors, and creditors, they help provide insight into whether a company can manage its cash flow effectively. Let's explore their purpose and importance in more detail. Definition and purpose. Liquidity ratios measure a company's ability to pay its short-term liabilities using assets it can quickly convert to cash. These ratios focus on assets and obligations that are due within a year, making them a critical snapshot of financial stability. At their core, liquidity ratios are designed to answer one key question: can this company pay its bills on time without running out of cash? Think of these ratios as the financial equivalent of a stress test. Just like you want to know if your car can handle a long drive without breaking down, liquidity ratios show how well a company can handle its obligations without financial strain. Common examples include the current ratio, quick ratio, and cash ratio, each providing slightly different viewpoints on liquidity. This information is particularly important for businesses in uncertain or highly competitive industries, where one missed payment could spell trouble. By understanding these ratios, companies can avoid unpleasant surprises and maintain a strong financial footing. Importance in financial analysis. Liquidity ratios play a key role in the decision-making process for various stakeholders. Why? Because they provide a straightforward way to judge if a company is financially stable in the short run. Here's how different groups use them. Investors. Before putting money into a company, investors want reassurance that their investment is safe. Liquidity ratios help them evaluate whether a business can handle its immediate obligations or if it's at risk of cash flow problems. Creditors and lenders. Banks and other lenders rely heavily on liquidity ratios to decide if a company is creditworthy. A low ratio might raise red flags, signaling that the company could struggle to repay its loans. Management. For business owners and leadership teams, liquidity ratios act as an internal compass. If the ratios are trending downward, that's a signal to adjust operations, perhaps tightening expenses or seeking additional funding, to avoid running into trouble. In practical terms, these ratios are like the early warning systems for financial issues. For example, if a company's quick ratio drops too low, it might suggest they're overly reliant on selling inventory or securing new loans to stay afloat. This kind of foresight lets decision-makers take corrective action before things spiral out of control. Whether you're an entrepreneur managing cash flow or an investor assessing risk, liquidity ratios are the foundation of smart financial decisions. They may seem simple on the surface, but they pack a lot of insight into a single number. Without them, judging a company's financial position becomes guesswork, and in business, that's never a good strategy. Types of liquidity ratios. When it comes to cash flow, liquidity ratios are key indicators that measure a company's ability to cover short-term obligations. Each ratio focuses on a unique aspect of liquidity, giving businesses and investors a well-rounded view of financial health. Understanding these ratios can help spot potential issues early or confirm that things are on the right track. Current ratio. The current ratio is one of the most commonly used liquidity metrics. It compares a company's current assets to its current liabilities, offering a snapshot of how well the business can pay its short-term debts with assets it can quickly convert to cash. Here's the formula. Current ratio equals current assets divided by current liabilities. A ratio of 1.0 or higher is typically seen as healthy, meaning the company has enough assets to cover its obligations. For example, a current ratio of 1.5 indicates the business has $1.50 in assets for every $1 of liabilities. But having too high of a ratio isn't ideal either. It could suggest that resources aren't being used effectively. Why is it important? Creditors, lenders, and investors lean on this measure to judge short-term stability. It's straightforward and widely understood, making it a go-to metric for assessing whether a company can ride out its current financial commitments without stress. Quick ratio, acid test ratio. The quick ratio is like the current ratio but with a sharper focus. It strips out inventory and other less liquid assets, assessing only what's immediately available to pay debts. This makes it a more conservative measure, especially useful for businesses with slow-moving or unpredictable inventory. The formula looks like this. Quick ratio equals current assets inventory divided by current liabilities. The quick ratio zeroes in on how ready cash and equivalents, like accounts receivable or marketable securities, stack up against liabilities. A typical benchmark is also around 1.0, but the ideal number can vary depending on the industry. Why does it matter? Unlike the current ratio, the quick ratio assumes that inventory may take time to convert into cash, or may not sell at all. For this reason, it tells a tighter, more immediate story of liquidity. It's particularly valuable in industries where inventory is less predictable or harder to liquidate, like retail or manufacturing. Cash ratio. The cash ratio raises the bar even higher, measuring how well a company can meet its short-term liabilities using only its cash and cash equivalents. It's the strictest of the three, focusing purely on liquidity that's available right now. Here's the formula. Cash ratio equals cash plus cash equivalents divided by current liabilities. If the ratio equals 1.0, it means the company could pay off all current liabilities without needing to sell assets or collect receivables. While this ratio may seem less practical in a day-to-day sense, it's a powerful tool for assessing absolute liquidity. Why is it important? The cash ratio gives investors and creditors a sense of a company's worst-case scenario readiness. While it's rare for businesses to maintain such high liquidity, since cash is often better invested, companies with strong cash ratios can navigate unexpected financial challenges more effectively. These three ratios, the current ratio, quick ratio, and cash ratio, offer unique perspectives on liquidity, each with its strengths and limitations. When analyzed together, they provide a deeper understanding of a company's short-term financial health. Understanding them is essential for better decision-making, whether you're running the business or considering investing in one. Calculating liquidity ratios. Understanding how to calculate liquidity ratios is essential for evaluating a company's financial health. These ratios help you see how well a business can handle its short-term obligations. In this section, we'll go through practical, step-by-step guides for the current ratio, quick ratio, and cash ratio, complete with examples. Let's keep it simple and actionable. Step-by-step guide for current ratio. The current ratio is one of the easiest to calculate and understand. It looks at how many times a company's current assets can cover its current liabilities. Here's how you can calculate the current ratio step by step. Identify current assets. Pull the total current assets from the company's balance sheet. This includes cash, receivables, inventory, and other short-term items. Identify current liabilities. Check the balance sheet for total current liabilities. These are obligations due within a year, such as accounts payable, short-term loans, or accrued expenses. Apply the formula. Use the formula. Current ratio equals current assets divided by current liabilities. Example. A company has $200,000 in current assets and $120,000 in current liabilities. Plugging these figures into the formula gives current ratio equals $200,000 divided by $120,000 equals 1.67. Interpretation. This ratio of 1.67 means the company has $1.67 in current assets for every $1 of liabilities. It's a healthy ratio, signaling the company can comfortably meet its short-term debts. Remember, while higher is often better, an extremely high ratio might mean the company isn't using its resources efficiently. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.